Shift our focus towards the earnings corner because Swiggy has reported its numbers for the quarter gone by, and it's reported a marginal improvement in its bottom line as far as Q1 is concerned, with net loss narrowing to 791 crores from 800 crores in the previous quarter. Meanwhile, if we talk about revenues, well, revenues have grown 6.7% sequentially to over 6,800 crores. The improvement in performance was clearly driven by the quick commerce segment, where revenues of the company have grown over 16%. And what are the numbers? Well, the revenues have grown over to 1,200 crores. Meanwhile, food delivery business grew at a slower pace of about 6.5%. As compared to the last quarter. My colleague Harsh Saida is getting us more inputs on Swiggy's numbers. Harsh, so clearly it is the quick commerce business that's grown the most, but how are the other segments as far as the company is placed? How are they placed? And secondly, what's the management's commentary on the quick commerce business in the months going forward?
Well, yes, so you saw the numbers with regard to the revenue flashing on the screen, but let me also quickly take you through the GOV numbers first off for food delivery and for quick commerce. So when you see the GOV numbers, EBITDA came in slightly softer on the food delivery side of things. So that may be a bit of a disappointment, where margins have cooled off from 3.3% Q4 FY26 to 3.1. So you've seen a 20 basis point decline there on that margin number. So that may not be the best, with regard to how investors view that number. They may not really like it as much. Quick commerce, though, the profitability has improved, and that is evident from the way in which contribution margins moved from negative 1.8 contribution margin now moved to 0.2, which is quite a sharp improvement. 165 basis point improvement sequentially is what we saw, and that will give some comfort to investors, especially because now quick commerce obviously is one of the mainstays for Swiggy, both in terms of valuation and profitability for both of these platform companies. As a result of that, let's have a look at how the margins have shaped up and EBITDA has shaped up. Well, absolute EBITDA was negative 650 crore versus the estimate of negative 515 crore. So you've seen a large delta. The profitability has taken a bit of a hit, and that's because to some extent because of food delivery not living up to the standard. The other one is the loss coming in as a result, or the net loss, the bottom line net loss coming in at 791 crore versus the 717 crore estimate. This number was at 800 crore, so not a meaningful improvement seen on a sequential basis, just about a 1 percentage point improvement that we've seen on a consolidated basis. The EBITDA margins, though, have improved from negative 10.9% to approximately negative 9.5%. So that has seen a bit of improvement, but that's not translating to profit improvement, and of course the absolute number not helping at all. The top line was a little bit of a beat, but EBITDA and profitability has certainly disappointed. And that is driven, that disappointment may well be driven by the food delivery business rather than the quick com business.
Right now.